Look, Chris, we talk about the mood, particularly compared to where we were a year ago.
Yep.
Everyone saw the Fed hiking rates. Everyone saw maybe the potential for an economic downturn. But we also talk about those long and variable lags. It has been long and variable, Chris. Where are we here? Where are we right now in this process?
Muddling along, and we're always told, don't say it's going to be different this time. But we've never had a pandemic. We never have stopped the global economy, and we never have had to restart it. And you hit upon the point, it's a long lag. So, I think the view here is everybody is expecting a recession. I've said that 9 months ago, so I'm so old on that. Eventually, if it happens, it'll be the most anticipated recession in history. But I fear that we're actually going to muddle along. The Fed will pull off a soft landing. Inflation will slow.
You think so?
I really do.
Oh, okay.
Inflation will slow without a recession, but then we still have inflation in 3 to 4. You have employment still being strong, the consumer moving along, and no growth.
Yeah.
Something like 1% to 0.9%, which feels like a recession. I almost feel like we could be saying the same thing next year,
right,
and even the year after that.
Months ago, you called for a recession. You said it was coming. Months ago, I don't think we could have had a realistic conversation about a credit crunch or a credit crisis. But given the failures of 3 big regional banks just in 2 months' time, more or less, and other big lenders making it clear that they're pulling back, are you preparing for a credit crunch?
I think what we're going to see is, Romaine, the fact that the Fed's gone from 10 hikes in a row in 9 months, 0 to 500 miles an hour, that has to have a powerful impact. I don't know that it's going to be a credit crunch, but what we're certainly seeing is a slowdown. We don't know the value of office, particularly office, C-level and B-level properties are probably need to be written down, but people are going to hold those loans. They're going to extend and pretend. Again, it's
right,
not bad news, but it's muddle along and not good news.
How much exposure does Calstrs have to that commercial real estate space right now?
We have a really solid real estate portfolio. So we're about 16% in real estate. So it's a really large portfolio. But there are parts like multifamily, industrial. People love distribution centers. Those are doing fine. Very low in retail, but in office, we have a beautiful office portfolio. Class A office, you guys are back in New York. That's
right,
good.
Yeah.
So Class A office is going to survive. It's the less sub-level cities, level 2, level C cities,
right,
and the lower quality office buildings that are already unoccupied because everybody's working from home, and they're going to have trouble.
But even at the Class A level, there's a concern that we're not going back to that 100%, whatever the occupancy rate was prior to the pandemic, that there are just some structural changes in how we work. There's always going to be a segment of society that has that flexibility to work from home or at least from places outside their core office.
Absolutely.
Does that not change the valuations at all?
What immediately happened is everybody canceled their options for additional space.
Okay.
Because they realize now they need to re-optimize the space. Remember, we were cramming people together in communal workspaces and thought that was cool. Now with COVID, everybody wants to be separated.
Yeah.
So I think there has to rethink it. It's really interesting out here, picking up the vibe that New York is back 4 days a week.
Yeah.
But as you come west, that backs off to all the way down to 2 days a week.
Right.
And there's a really different attitude on the West Coast, even between LA and San Francisco, about remote work and in office.
Well, you guys have always been slackers. Is that going to change? I'm joking, of course. But do you anticipate that changing, though? Because I know on the East Coast, particularly in the world of finance, you've seen that pullback, saying, look, we need everyone back in the office, if not 3 days, maybe even full 5.
Finance and particularly money management is a mentoring business, an apprentice business. And I've really come to realize we really lose that in a Zoom setting. People miss the interaction. Will we come back? Very slowly. But if there's a recession, I think you'll see employers really put down and say, we want everybody back quickly.
Yeah.
When there's lots of job opportunities and employment is tough, then employees rule and they get the choice.
All right, we're at the Milken Conference, obviously a broad and varied conference, but at the core, a lot of folks from the private capital markets. We know pension funds, including Calstrs, have really embraced that as an allocation. Are you continuing to expand that allocation into private markets?
Not expanding, just steady state investors, so constantly growing. Our asset base has been growing, so we're staying committed to private equity, real estate. We like private credit in here. Infrastructure, those are all opportunities. Those markets are really slow. They are not moving. We're not getting distributions back, but we're also not able to see many people draw down. M&A, Merger Monday, is not happening. I mean, every once in a while you report on it, but it's pretty quiet.
How confident are you, though, when it comes to your private assets? How confident are you in price discovery, in an accurate valuation of what's really on your books?
Our auditors just talked to me last week about that. It's a concern. But with a lack of transaction, it's hard to argue the price should come down. What's amazing is that employment number that we're seeing, the strength in employment, the portfolio companies are seeing that too. So the consumer is resilient and the portfolio companies are hanging in there. So that's why PE doesn't want to write that stuff down.
With regards to the regional bank crisis, how much exposure did Calstrs have, if any, to some of those regional banks that teetered?
You know, we own the entire market, so it's a market weight exposure with the regional banks. Some cases we have relationships with them for other services, so that's hurt. And I'm really concerned. I mean, you know, First Republic was a well-run institution, had a decent book of business, but obviously with a lack of confidence of depositors, you can see money move. In a digital age, it moves 24/7 just with a touch of a phone.
We only have about a minute left, but I do want to get your thoughts on the California economy more broadly. With the weakness in Silicon Valley Bank, the weakness overall just in venture capital, and now, of course, we have a writer's strike here in Hollywood that could potentially have some consequences here. I mean, how healthy is this economy right now? The largest in the country.
Yeah, California still has awesome weather. Maybe it's a little cool here in Palm Springs.
Well, it did rain
in Beverly Hills today. But, you know, I think it's still going to be strong. VC is going to have a hangover because First Reserve and Silicon Valley Bank were major providers. But people will step into that gap because it's an amazing opportunity. So we're going to see innovation and growth. It's just going to be slow. Again, muddle along.